To my immediate left is Shamik Trivedi, who, and I'm sorry, you are with Grant Thornton?
Yeah, I'm a senior manager in Grant Thornton's National Tax Office in Washington. I work mostly in tax controversy and IRS procedure issues.
And to his left is Rochelle Hodis, who's with Crow in Washington.
Yep.
But for purposes of this presentation, Rochelle is Rose.
We debated Rose or Rosé. So if you have a preference for your presentation, let us know.
We are perfectly amenable to either name.
Okay.
Shamik is her accountant, because this involves a lot of accounting, and she wanted to make sure her accountant attended the meeting.
Okay.
And I am the senior partner in the law firm.
Okay.
And we will let you know when there's 5 minutes to go in your presentation. And as the saying goes on Chopped, your time starts now.
Okay, great. So thank you for meeting with us today. You had asked us to take a look at several issues for you. And what we'd like to do to start off is to just present our conclusions to you, and then we'll go into a little more detail as to how we arose or how we arrived at those conclusions. We can really separate your issues out into two categories. First is the vineyard. You had a $600,000 loss, and the issue presented was whether or not the vineyard constitutes a trade or business. And we do feel like that based on the information that was provided to us in our research, that you do have at least a reasonable basis to take up the position that this is a trade or business, meaning that the loss would be fully deductible. Now that does come with some risk. There is a risk that the IRS could disallow that loss upon audit. And if you're deciding to take this position, we're going to recommend considering disclosing it on the Form 8275. Tom is going to talk a little bit more about the factors that went into that analysis, and then some additional information we'd like to get from you if possible, and then if we have some time towards the end, maybe some just recommendations.
I was hoping not to have to interrupt you quickly, but you're only
Yes.
reaching a reasonable basis level of comfort. Do you understand what that
And
means?
I'm not putting a disclosure on my return.
I don't want her to
So
get audited. That's my biggest problem.
I'm
Yeah.
not sure that I want to raise my hand and say that this doesn't work.
Mhm.
But, when we talked about it before, I was under the impression, as Mr. Lipton said, that I had pretty good reason to believe that I had a deduction here.
And sure, and so we're clearly at reasonable basis, and what we'd like to do is just get a little more information from you, and we'd be solid at substantial authority, and then even get some more likely than
And
not.
what do these terms mean? I don't know.
These are various comfort levels when you're taking a position on a tax return. Reasonable basis is just going to be the baseline threshold for you to be able to claim the position. Substantial authority, you wouldn't need to disclose the position, and then just more likely than not, well, it's just a percentage gain. You're more likely than not to win upon audit in that case.
What if we just don't disclose? I mean, we could just claim
Do I
reasonable
have to
basis.
pick?
Do we get to pick?
I'm sorry, can you say that again?
I mean, what if you're saying you're at reasonable basis at least with disclosure?
Yeah.
What if we just don't disclose?
If
What's
you
the
don't
problem?
disclose, that's not a problem. I mean, that's totally your choice, Ms. Risling, if you chose not to disclose the position. The reason why you want to consider disclosing if you're only at reasonable basis is because if you get audited and you lose on the audit and the loss is disallowed, the $600,000 loss, then you could also get hit with, the tax would be around that 40%, around $240,000. There'd be some interest. And then if there's what's called a substantial understatement of tax, under 6662, you could get hit with an accuracy-related penalty, 20% on the 240. So we're on a $50,000 penalty, but that's if you disclose, that penalty would go away, but you don't have to disclose. So if you're comfortable with that exposure, potentially, then you just you wouldn't have to disclose it on the tax return.
Okay. Why don't you continue with the presentation, given the time, and let's get back to this.
Sure. So why don't we get right into the factors, or why don't we have Tom get right into the hobby discussion here, and then we can go into the disposition of the assets afterwards.
Thanks, Jordan. Again, good afternoon. Thanks for meeting with us. The first determination is going to be whether or not Pienza Vineyards is being operated as
And I apologize, could you talk a little louder?
Absolutely.
I just have no hearing issue.
Yeah, no problem. So the ultimate determination is whether or not Pienza Vineyards is being operated as a trade or business, or whether it represents a hobby for Ms. Riesling. The reason we delve into that, Ms. Riesling, is because their tax consequences look different based on that determination. So if it is a trade or business, you're going to be able to write off all relatable expenses attributable to that business. If it's a hobby in the 2017 return, you're going to be able to deduct the amount of losses up to the hobby income, in this case $3.6 million. There are some changes in the tax code, and those are reflected in some of the recommendations and some of the information we'd like to get from you moving forward. It's really going to help buttress our position that Pienza Vineyards is a business and not just a hobby. So the IRS lays out 9 factors that they look at. We examined the 7 most relevant and kind of looked at some of the interactions between the two to really help you understand where we're coming from with this analysis. So the first of those factors would be occasional profits that Pienza Vineyards is earning. We know in 2015, 2016, great news. You had distributors knocking at your door trying to get their hands on your product. That's great. We're lacking information for 2013 and 2014 as to whether Pienza had turned a profit. Do you know that offhand?
I'll go look at my account.
We'd have to look into it. I can't recall exactly if they turned a profit or not.
Yeah, that's fine. The reason we ask is because it would set up a rebuttable presumption that Pienza is a trader business, so that really lays the burden at the feet of the IRS to have to come back and explain that it's a hobby. So it's just something, again, that would move us further along that spectrum from, reasonable basis.
So the fact that, my career, looking at the next phase of my career,
Sure.
and I'm really enjoying ownership of the vineyard.
Absolutely.
Expanding. Despite this year, I think that things are going well. I think I'm on an upward trajectory. And so, looks like a business to me. The word hobby doesn't seem fair.
I absolutely agree with you. And this is a great point. It gets into another factor that the IRS examines. So they look at the personal pleasure you're deriving from the business. Well, why is that important? Because it's not a grind. The IRS is going to take the position that one of your major motivating factors in pursuing this line of, or this enterprise is that you're deriving pleasure from it. You're on the record saying, yeah, it's a great opportunity for me and my friends to have wine. And listen, there's case law out there. Judges and tax courts have found that golfing, yacht chartering, this stuff can constitute a business, it's great for us. So again, we'd like to elicit more information and really.
I enjoy what I do.
You don't have to do your job.
And hopefully you guys will enjoy what you do.
So,
You're asking her to get more information about what specific information do you want? I really want to
Right,
focus
so
in
that-
on what is needed here.
Okay, that goes into another bundle of factors that the IRS is going to look at, and that's kind of the business operation side of Pienza Vineyards. One of the factors is whether or not it's being run in a business-like manner. So, to buttress our position, we'd like to know the manner in which it's operating. If the primary motive here is to generate profit, is she maintaining separate business and personal records?
Okay, but look at the facts that we have.
Sure.
Let's forget what ones we don't know.
Okay, and
How many cases are produced?
so we came up with a 60 cases per acre and compared that against the national averages. A moderate-sized vineyard is going to produce somewhere around 200 cases per acre. So we're on the low end of that. That isn't necessarily dispositive of the trader business aspect of Pienza Vineyards, because even in the IRS audit guide used for wines, it's an internal document, they acknowledge that upon acquisition, which Ms. Riesling did expand Pienza's initial purchase, it takes time for vines to mature, promotion. It could have been impacted by drought. So
It's still 12,000 cases a year. Last time I looked, that's a lot of cases of wine. And Rose, how many bottles did you personally cork and seal? I assume none.
I may have gone in and saw how the process worked, but I have managers that I hired because even though I own this business,
Yeah,
I'm not a vintner.
Actually, I have this wonderful vision of Rose stomping the grapes with the and
Like
she is a movie
Lucy.
star, and it's a
Like
really nice
Lucy.
vision. But I don't think
Absolutely.
she does it.
which is great. I mean, honestly, we're loving what you're telling us on this side of the table, because again, this
So
does.
are you saying that like somebody who owns a restaurant but doesn't have any other part of the business, doesn't have trade, is being treated as if they have a business?
So one of the factors the IRS looks at in a case like that is whether or not you're retaining industry experts. Now, you just mentioned you have managers. Are they familiar with producing wine? Obviously, if they're able to do it.
Obviously, we're
12,000.
selling something.
So again, none of these factors are falling clearly into a trade or business column or a hobby column. We're not going to just take a cumulative measure here. There are mitigating explanations, and there's some interesting case law out there that buttresses our position. One of the cases I'd like to draw your attention to was Shane B. Robinson. Like you had a gentleman that was, he was generating significant income as a tech executive. He had a horse farm. It generated $9 million in losses over a 15-year period, and yet was still deemed a trade or business. So again, we're confident that we're a reasonable basis.
Well, what's bothering me here is, given these facts, and given what I will call, and I believe it's in the regulations, just the so-called common sense test,
Okay.
and the whole theory of a hobby loss, how is this even remotely a hobby when just drinking the wine is no different than eating the food in a restaurant? Or, I can run an art gallery because I like looking at art, but doesn't mean, but I don't spend much time there. How's that only a reasonable basis?
And we think that with this reason, again, we're confident in the reasonable basis, and we're moving towards substantial authority. Ms. Riesling is a higher profile taxpayer. She's already generating a significant amount of income. So again, we're trying to phrase this in a way that she's comfortable with the exposure. And again, that's why, to avoid those accuracy-related penalties, we recommended a disclosure. But again, that's at your comfort level. And another one of the factors that doesn't weigh so heavily in our favor is the fact that she has a strong financial position independent of Pienza. So the IRS may take the position that because she's not reliant on the profits of Pienza to keep Pienza going as a going concern, that might shade more towards them viewing it as a hobby. So again, it's another risk factor that we're trying to mitigate by eliciting more information.
I think from my perspective as an accountant, I'm the one signing this tax return.
Sure.
And I don't want to sign something that is incorrect or exposes Rose, and then by extension me, to some sort of liability because we can't get the substantial authority.
Okay.
And if we're on the fence, then I would have a real problem with signing that tax return without a disclosure. And Rose has just said she doesn't want to disclose. So what else can we do here? Is there a factor that weighs more than the others that we could say, this is why this is substantial authority versus simply only reasonable basis?
I mean, sure, there are other factors that do weigh in our favor, and one of those was the purchase of the vineyard with the expectation that the assets can appreciate. Ms. Riesland, I know you're not a real estate local, but you had to have anticipated that land with an operating vineyard on it was going to go up in value over the course of time, and whether or not that was going to offset losses. So again, that's something that might, again, move us further down that spectrum towards substantial authority.
Have you done any looking at what happens to the value of land that can be used to grow grapes?
I don't
Have
know.
you looked at the history of that in California?
I don't know if it's soil depletion or if it complicates the
No,
arability of the land.
it's the opposite, is that once land is permitted to develop grapes, to grow grapes, you will find that throughout the grape growing region, just getting the permit to grow grapes takes the value of the land up about tenfold.
Again, that's a fantastic factor in our favor.
Yeah. So as we're talking.
Well, and what about the land, the additional land that I bought?
Yeah.
Does that help?
Yeah, the subsequent acquisition. And we also think, looking forward to, you had expressed interest in operating a tour component to your business.
Absolutely.
That's great. Think about hosting and leveraging your persona into promotion. We want to make sure that Pienza is first and foremost a profit generator for you.
So how can we? I heard what Shamik said. Bottom line is, he's going to tell our client not to take this position unless you get to substantial authority. What are you going to do to get her to substantial authority in the next few days so that he is comfortable that he can sign a return?
Well, just from the discussion that we've had here about the operation of the vineyard and how it's been operated in a business-like manner, you said you've hired individuals that are experts in the wine field. We do feel like we're pushing it now to the point where we do have substantial authority, that we do have enough here based on the previous facts that you've given us, and then from the discussion today, that we're much more comfortable taking that position that we do have substantial authority based on our previous case law research. And so with that, we'd like to shift gears. If we're all set here, maybe we could shift gears over to
Absolutely.
the disposition of the assets. I'd like to make sure we have time to get to all of that.
Absolutely.
We can start off and we can start working through some of these vineyard assets. We have your wine tank. Ms. Riesling, you sold that for $1,000. From that, you can subtract out your cost basis in that, which was your original $2,000. You took a previous depreciation of $500, so you had an adjusted basis of $1,500. I have the figures on page 2 that will help to kind of go through the numbers a little bit. And because the wine tank was used in your trader business and you sold it for a loss, that's $500 loss, that'll be an ordinary loss.
Why is it an ordinary loss?
Because it's tangible personal property. It falls outside the realm of 1221, 1222, it's not a capital asset.
Why is it in 12, you're saying it's in 1231, correct?
It's not, no, I'm not saying it's in 1231 because it was not held for a year. So it's got a tangible personal property held for a year, would get a 1231 treatment, and then you'd have to look at your 1231 gains to
Why,
mention that.
I'm sorry, Shamik, correct me if I'm wrong, what you're saying is it's an asset
Mhm.
that's not in 1231,
Mhm.
because it wasn't held a year. Why does its sale generate an ordinary loss rather than a capital loss?
Because it does not meet the definition of a capital asset.
What is the definition of a capital asset?
It's kind of almost like in reverse. It's almost kind of like a reverse definition, like everything is a capital asset, and then you kind of kick things out.
So why isn't this a capital? Where does it get kicked out?
It gets kicked out because it's tangible, depreciable personal property.
But it's not kicked out because it's not in 1231.
Right, but it's property that's used in a trade or business. It doesn't have to necessarily be 1231 property under 1222.
Okay, so you think that under 1220, this turns into an ordinary loss. So then why do we even have 1231?
Well, 1231 is just for a property that's held for more than a year.
So you're saying if it's held for more than a year under 1231, you get an ordinary loss, but if it's held for less than a year under 1222, you get an ordinary loss?
Mhm.
Okay.
Yes. And so the difference there would just be that for 1231, you'd have to net it against your 1231 gains.
Mhm.
And so,
So you get more favorable treatment outside of 1231.
in this particular instance, I mean, if we had sold this at a gain, it wouldn't have worked out for you because it would have been ordinary income.
Okay.
So it's just kind of the way this worked out. In this case, you bought an asset, held it short term, and we lost money on it. So in this case, it worked out.
So, Shamik, should I continue to buy things and hold them for a short period of time and sell them like this?
Well, why
so
don't you
that
ask
I
them?
can-
What do you recommend her? Look, she's getting an ordinary loss. Should she be
This sounds
selling
like a
everything
good
quickly
deal.
or selling them long?
It sounds almost too good to be true.
Well, I mean, economically, you're out the money. So you're out of the, you're economically out of the dollars out of pocket, so I'm not going to recommend it. I mean, it might produce favorable tax results, but net in your pocket, you're still out of the money. So I wouldn't recommend just buying and flipping assets, especially for your trader business. You want to be using these assets for your trader business, and hopefully we can hold on to them for more than a year. So with that, we have also your wine press. So you had a $1,000 gain from your wine press, and that's for a $5,000 sale price, $4,000 adjusted basis. Now, this is a 1231 asset because it was held for more than a year in your trader business. Ordinarily, that would be capital gain, but in this instance, you have to recapture all the depreciation up to your original purchase price in the asset, and that gets recharacterized as ordinary income. And so, since your original cost was $6,000 and you only sold it for $5,000, it's below your original purchase price. That $1,000 of gain is all going to be recaptured as ordinary income.
Now, who was the purchaser of this?
In this case, it was a company that was owned more than 60% by Bud.
And Bud was,
Bud.
I'm
I've
sorry,
had
I'm not
enough
supposed to say
Bud.
that.
We don't talk about Bud.
I wasn't gonna bring it up.
I've
But,
had enough.
so that does come into play, but it actually isn't going to matter. It could matter if you had sold this for more than $6,000. There's some special rules that would kick in and recharacterize anything above the $6,000. But because you sold it for less, there's another code section that comes in 1245 that's going to come into place as ordinary income. So we'd only have to worry about the related party, the 1239 issue, if we had sold it for more than $6,000. So it's ordinary income. You didn't receive all the payments.
Is there different treatment ever under 1245 versus 1239? Is there any offsetting, recapturing, netting, or is it just, it doesn't matter at all?
Well, I mean, if we had, see, in this case, it actually would have mattered, right? So in this case, we had an installment sale. And so under the installment sale rules, you didn't receive all the payments in the same calendar year.
Okay.
You received some in 17, some in 18, and ordinarily,
5 minutes.
thank you, ordinarily you wouldn't be able to, ordinarily you'd recognize gain as it's, you receive payments. Under 1245, you can't defer any of that payment, or you can't defer any of that income, excuse me. That's all recognized. So at that $1,000, even though you don't receive all the payments, it's all recognized in 2017. 1239, there would be a potential to defer that as long as, in this case, tax avoidance wasn't your principal purpose, but maybe
What do you say?
tax avoidance wasn't a principal purpose of the
Why
transaction.
would you even raise that?
That's what the code says. I mean, they have that in there, and they would want to make sure that if you're entering in this transaction, but it didn't even actually come into play here because it was all 1245.
Given the limited time, we better go through the other assets and
Sure.
get your thoughts.
So let's go into the storage unit. Because this was using your trader business, you can actually, and it was completely destroyed, you can take a $2,500 loss as your starting point, your adjusted basis in the property. What we didn't know, that's just the starting point. You got to reduce that by any insurance reimbursement.
Yeah, we don't know what that's going to be yet. We haven't been paid out yet.
Have you had any indication that they're going to deny it, or is it just they're taking their time?
You know how these guys are.
Yeah,
they take their time. Now,
Yeah.
if they did pay it all out, would we still be able to take a deduction on this?
You have to reduce it by the amount of insurance reimbursement. And actually, if you get more than your adjusted basis, you could have potential gain, but then, in 1031, 1033, you could then defer that by buying like-kind property. So, I'm sorry.
Continue.
Yeah, so in this case, if they're still kind of deferring it, there seems to be a reasonable prospect of recovery. We're just going to have to wait on that loss. And then, Tom, why don't we talk?
Yeah, I'll talk about the necklace real quick. So the necklace was sold for $15,000. Your basis in the necklace will be $12,000, and that's because there's a step up in basis. We have an appraisal coinciding with the time you inherited the property. Generates a $3,000 gain. It's going to be taxed at 28%. So you had it less than a year, but because it is inherited, it's going to be deemed long-term held property, but not taxed at the 20% normal long-term capital gains rate. It'll be 28% because in the code, section 408M tells us that jewelry is a collectible. Section 1H tells us that collectibles are taxed at 28%. So there's an $840 tax liability there.
Would she still have to pay the Obamacare NII tax on that?
1411
tax?
Yes, for 2017, yeah, the 3.8, yeah, that gets factored into your net investment income.
So it's not 28%, it's really 31.8%.
Yeah, it would get added in there as well. Yeah, that's correct. And so finally, we just have two more assets to go through, and kind of the shortcut answer here is there's going to be no gain or loss from the disposition of the stock to Bud and then the potential sale of the car to your uncle. There's no gain or loss from the stock transfer that occurred in December because of what's called Code Section 1041. Now, I didn't get from you whether or not the divorce was finalized. I know you had filed in October. Is it still ongoing?
It's only November. I mean, these things take
A while. Yeah, that's what we kind of assumed. So since you were married, that at the time of the transfer, there would be no gain or loss. And I assume we're going to have a discussion at some point about filing status, married filing joint, married filing separately, because they were still married at the end of the year.
Yeah.
Yeah.
So, I mean, we still do Bud's return as well, and I know we don't talk about Bud on this dais, but what's Bud's basis in that? Does he have to worry about?
It's a carryover basis
Okay.
in that instance. Yeah, you'll have a carryover basis.
And then finally you have the car. And so you acquired this in what's called a bargain sale. So your aunt sold it to you for less than the fair market value of the car as of the date of the transaction. So she had purchased it for $6,000, you bought it for $3,500, fair market value was $5,000. If you sell this to your uncle for the proposed price of $2,000, the way the rules work would be actually your basis for determining that loss is $5,000. But because you acquired that asset for personal purposes, the loss is going to be personal non-deductible under 165. So there's just not going to be any gain loss from that.
Is there any argument we can make, even get it, as long as we're playing in the reasonable basis world, that she was using this car as part of her trade or business, maybe part of the vineyards?
Well, we'd have to look into that. I mean, was that the case, Ms. Risling? Have you been using the car for the vineyard?
Well, sometimes, yeah. I
Okay.
mean, it was kind of beat up, and I figured it was just the right thing to be on the
Okay, so
property.
I think
We'll
we'll,
have to take a look at, there's some listed property rules we would need to go through and consider that, but we can follow up with you on that as well.
All right, well, thank you very much. Your time is finished. We appreciate it.
Thank you.
Thank you so much.